wabarakatuh. My name is Hama Supriyanti. My number is 21. Today I will explain about the equity securities. The definition of equity is typically referred to as shareholders' equity or owners' equity for privately held companies. Represents the amount of money that would be returned to a company's shareholders if all of the assets were liquidated and all of the company's debt was paid off in the case of liquidation. The type of securities is divided by two. The first is debt. Debt securities are proof of debt ownership in the form of securities depending on the deadline for payment or other characteristics. This type of securities typically include government bonds and bond certificate of deposit and guaranteed securities. Usually, these types of securities are valid for a certain period of time, which are then redeemable in the end. And the second is equity. Equity. Equities. Example, bonds and stocks. This type of security is ownership by shareholders in an entity, for example, in the company, which is obtained in the form of shares and includes some common stock and preferred stock. Shareholders usually get the right to control the company through voting rights. There are five journal entries of security equity. The first is purchase the stock investment. The second is receive dividend payments. The third is recognize net income after issuing the corporation. Next is adjust the fair value, and the last is sell the stock investment. The first is purchase the stock investment. There is no difference between the fair value through net income and equity methods when stock is purchased. The account used in the journal entries are identical under both methods. This is the method. The second is receive dividend payment, divided by two methods like that. In fair value through the net income method, under the fair value through net income method, the investor simply reports dividend receipt as revenue. The dividend revenue account is credit. And the equity method, dividend receipts are reported as a reduction of the investment account. Investing a company's significant ownership percentage result in a transaction that does belong to the corporation paying itself. The third is recognize net income of the issuing corporation. In fair value through net income method, there is no journal entry under the fair value through net income method, where the percentage of investor ownership is not considered significant enough to participate in the issuing company's earnings. And in the equity method, investing corporation owns such a significant percentage of the issuing corporation shares that it actually takes ownership of its percentage of the issuing corporation net income and reports it as own. And adjust to fair value. This is the journal entry. And the last is sell the stock investment. In fair value through net income method, a final difference between the two methods is on the sale of the investment. And this equity method, for the investment that